think it's about taking risk when you get compensated to take risk, and then taking your foot off the gas pedal when you're not getting compensated as well.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?
Hi, everyone. I'm Jason Balara, and this is the Know Your Why podcast. Today, I'm here with Michael Cannivet. Michael is the founder, president, and chief investment officer of Silverlight Asset Management. He's also a Forbes contributor and author of the 4-Minute Retirement Plan. We're definitely going to talk about that. I like a 4-minute retirement plan. Michael, first, I want to just say thank you for coming on the show today. I really do appreciate you taking the time out and to chat with me, and I'm looking forward to this conversation.
Yeah, thanks for having me, Jason.
Yeah, absolutely. Why don't we just start with your background, kind of tell us a bit about yourself, and then we'll just dive into it and have a conversation.
Okay, where do I start? I'm originally from Chicago. I've lived all over the country, went to school to study government at Georgetown University, decided I did not want to be a politician, discovered the stock market and investing in between my junior and senior year in college. I did an internship at a venture capital firm in the year 2000. For those that don't know, that was pretty much the apex of the tech bubble. So everything was very exciting when I was doing my internship, and we were investing in companies like Meet.com and some things like that. And in 2001, when I graduated college, the tech bubble was in the midst of bursting. So I had kind of a roundabout path to find my way to the stock market after that. And my first real job, I think, in the stock market was at Fisher Investments. I worked for Ken Fisher as a research analyst specializing in equities. And then I left that role in 2009 to join a registered investment advisory firm in Newport Beach that was kind of just getting going. And I wanted to flex my entrepreneurial itch and try to do something different there. So I joined a small firm, helped grow it about 500%. And then I started my own firm.
Okay.
Silverlight Asset Management was launched in 2019 or 2017.
Okay, perfect. So that's been into your 7th year. Let's talk about kind of that background first. You mentioned the tech bubble, and I'm actually interested to kind of hear about that time in your life and your experience, because as we talked ahead of time, this is a largely we talk about real estate on this podcast, but I don't think real estate is the only place people should invest. I think there's reasons to be diversified and whatever. But we've talked a lot about kind of the 2008 crash on this. I've talked to other investors that have been through it. I've talked to people. We've talked about kind of what's going on currently with real estate, but I haven't had the opportunity to talk to anyone about kind of that, what that looks like on from someone who's actively in the stock market and kind of working in that space. So what did that, I'm intrigued as kind of what that looks like for you. Maybe it looks a lot like a real estate crash, I don't know, but I'm really kind of interested to hear about how that looks from your world.
In terms of where we are today, or where we were in a specific period in the past?
Yeah, where we were when you said that you were kind of coming out of college and the tech bubble was bursting. Okay. What did that time in your life look like? How does that get sort of navigated?
Sure. So well, I think that was my first real lesson in risk management as an adult. My first real lesson in risk management was as a child. I think my first investing hobby was baseball cards. If you were alive in the 1980s, like I was growing up as a little kid, that's a time when baseball cards were really popular. So once I discovered that they could go up in value, I became intrigued by that. And I started to study baseball player statistics, try to figure out which cards would go up the most in value. I'd look at the Beckett monthly price guide when it would come in the mail every month. That was one of my favorite days of the month. And so I sunk pretty much all of my savings into baseball cards when I was a little guy. And the prized possession, the biggest investment I made was the 1983 Top Set. And that was not a very good investment. Number one, because my dog ate half the cards shortly after I bought them. That was tough. But then there was this kind of bubble that I formed in baseball cards, because what happened is they became more popular in the 80s was the companies started to print more cards. So Topps was usually the main brand, but then Fleer and Donruss started to, come in and compete. And then after that, Upper Deck and Score and these other companies started printing cards. And what that caused was an oversupply of the market. So prices pretty much stopped going up in the late 80s. And I think that's very analogous to what happened in 2000. There was an oversupply in the stock market when the tech bubble was going on. Companies could issue shares easily, and investors would willingly gobble them up. And when that oversupply happened, I think that's what led to the 2000 to 2002 tech bubble crash. Fast forward to 2008, that was my first real front row seat for a bubble as it was bursting. At that time, I was an equity analyst at Fisher Investments, and one of my jobs, in addition to studying stocks that I was assigned, was to travel around the country and do investment roundtable meetings. And those were tough meetings because anybody that was invested in any equities that year was losing to some degree. And so, I think the 2000 bubble, 2008 real estate oriented bubble really kind of formulated my approach to investing from a risk management standpoint. One of the things I write about in the book is why I'm a safety first investor and why I think that's the path to get your best long-term returns. There's this thing called the efficient market hypothesis that you learn in Finance 101 and when you're doing the CFA program like I did. And it basically says that the only way to get higher returns is to take more risk. And I think that's hogwash. And I think the best example of that is Warren Buffett. He's the most celebrated investor of my lifetime and yours. And this is a man who runs an insurance company. What do insurance companies do? They take calculated risk and they try to avoid permanent ruin. Mr. Buffett is not a big risk taker, in my opinion. And you can see that in his investment track record, too. I point out in the book how most of his alpha or outperformance through the years has come during bear markets. One of the things he does really well is he protects capital in the downturns, and he actually takes advantage of the downturns because he's able to go counterstream to the consensus. And for instance, right now he's raising a lot of cash while the market's making new highs. That's hard for people to do, but that's what risk managers do. So I think that was really important to me. Based on my experience, it's fun in a bull market. You can throw a dart at a board and pick a stock and it works. But, when the tide goes out is when you see who's swimming naked, as Buffett says. And I think those are the real important times when the best investors distinguish themselves.
Yeah, I think that's absolutely true. I think the ability to sort of have life-changing wealth, I think, comes from downturns. That being able to understand how to navigate and take charge of that and take advantage of it. I think that as you said, in a bull market, anybody, you can pick a stock, it's going to go up, kind of thing. Like there's just because everything's going together is getting carried along. So I think, I'm sure you've studied Buffett a lot more than I have, but one of my favorite quotes that he says is, be greedy when others are fearful when others are greedy. And I, in a way, I feel like that is kind of it almost seems like anti or goes against him being conservative investor. But I know that's not the case I'm curious if you would maybe make sense of that for me and people listening, because I think that that almost implies like, oh, I'm supposed to take risk when other people aren't, and that kind of thing. But I think it's not exactly that. What's your take on that quote and applying it to him being kind of a conservative investor, or yourself being a conservative investor?
Sure, that's a great question, Jason. I've thought about that a lot, and I think it's about taking risk when you get compensated to take risk, and then taking your foot off the gas pedal when you're not getting compensated as well. A great example right now is the market's at an all-time high. That's great. Momentum suggests that we'll probably keep making more highs, at least in the short run. Bodies in motion stay in motion. That's one of the laws of physics. But there's going to be a point at which, things do change in the environment that we're in. And right now, if you look at what cash pays, you can make a little bit above 5% with risk-free. If you look at the earnings yield on a stock like Nvidia, which just became the biggest company in the world as of today, trades at 73 times earnings. So you're like looking at a low single digit yield on that stock. That may not matter at all in the next week or month or even year, but it will matter eventually, because when you get to higher valuations in any asset, the expected future returns go down. So what I think Buffett does well, and great value investors, even though they've been out of favor over the last decade, they tend to try to take risk when they're being compensated in terms of the yield that they're going to get. And they compare that to the risk-free rate. So the thing that's changed in the last couple of years with the Fed raising short-term interest rates is now there's a higher hurdle for all the other assets to clear to justify their sponsorship by investors. If you can't get better than a 5% earnings yield on a stock, you have to ask yourself why you're even taking the risk today. So that's kind of how I think about it. And when the bear markets happen, valuations usually go down along with earnings. So that means the yields or earnings yields go up. Usually bond yields go down when the Fed lowers the rates to combat the recessionary risk that's going on. So that yield differential starts to go from one way to another. And that's when you want to take more risk. You got to be in the market long term to get equity-like returns. You never want to be one of these perma bears that's always in cash or gold or some other thing like that. But I think it does pay to be prudent. And one of Buffett's quotes is, the more imprudent other people are, the more prudent you want to be. Just recognizing that in the markets, it's all about supply and demand, right? And so when everybody's already invested, there's less future buyers to come in. When people are scared and, kind of hiding in cash or other things because they're worried that a downturn is going to continue, you can, take your pick across a large cross-section of assets and usually get pretty good value. It's just hard to buy in those times because it's counterintuitive to our nature as human beings. If we're in a theater and someone yells fire in the back and everybody starts to scurry out of the theater, you may not see the fire or feel the fire. You may think everyone's crazy, but it'd be really hard to sit in your seat if everyone in the theater, evacuates, right? That's kind of what happens in markets. And so I think it's easier said than done, but entirely possible if you understand just very basic things about how valuations work in the market.
Yeah, I love that, and I think that it kind of brings me to what I wanted to ask you next. Even as you were saying it, I was like, yeah, this is something that fascinates me about. And it's not just the stock market. I think this really, you could apply this to real estate or Bitcoin or whatever. Like one of the things that I think is new, put new in air quotes, I guess, but new compared to even 10 or 20 years ago in terms of investing is social media and more access to information. And so I had heard, who knows if this is like really true, but I had heard that one of the reasons why we had those recent bank collapses is basically because people essentially had that same mentality. They heard fire at the back of a theater on social media, and everybody just ran and sort of pulled all their money out of the bank. And so I'm curious, do you think that the fundamentals of a company, right, are obviously important, but it feels to me very much that when it comes to investing, investor sentiment is equally, if not more important than those fundamentals sometimes, or it feels that way. I think it's not that they are more important, but especially in something like the stock market, where we generally don't have any input as to how those companies are run and kind of what their growth strategies are and things like that. You're really looking at, okay, like Nvidia, you mentioned Nvidia. I'm very, very happy that I have Nvidia stock because it's done so well recently. But like, and that wasn't like something that I knew a lot about NVIDIA. It was just it sort of fit into something that seemed to make sense to me. And then you look at like the flip side is that whole debacle with GameStop, where that was almost entirely internet, social media, um, instigated, if you will. I mean, how do you look at this as someone who is really, professionally works in this space and is managing assets? How do you look at things like that? I understand people look at, I don't know, things that Elon Musk has done or said or tweeted, and then he says that no, people don't like what he said, and so the stock goes down a bit. But like this is almost bigger than that, in the sense that it's just people start to hear that fire in the back of the theater, and they're like, I'm going to run and buy this or sell this or whatever in mass. How much real effect do you think that has on, stock values?
I think it has an enormous effect today, more than any other time in our lifetime. And the reason I say that is in 2013, about 34% of the US stock market was in passive investments, meaning things like the S&P 500 index fund. Yeah. Today, that number's over 60%. So what that tells me is that passive investors, just for those that don't know, are people that basically don't try to pick individual securities. They just buy an index. And so the good thing about owning the S&P 500 index in terms of NVIDIA is you already own NVIDIA, and you've owned more of it as it's gotten it bigger in terms of its market cap and weight in the index. But as the market's migrated more towards a passive ownership base, what that implies is that the market's probably becoming more inefficient, because it means less and less investors are actually doing the homework to scrutinize the fundamentals of the companies. They're basically just chasing momentum. If you own an index fund, you're in a vehicle that does one thing. It buys the biggest, most valuable companies every day. So if a company's been going up a lot, it'll keep buying more and more of that. So what we saw with GameStop, for instance, and that was an interesting period in 2021. Now it's reemerged this year. It had a nice run up a few weeks ago and then crashed back to earth again. What's funny about that is you've got a stock that any professional investor would probably look at and say, my goodness, this is so overvalued, it's not even funny. But if enough retail investors believe the opposite and are willing to buy it, they can price it up to the moon, right? And when they do that, the passive machine also buys. So I think the passive machine that is dominating the market today is exacerbating price moves up and down. And so this momentum feature has become extremely important in the shorter term. I still think valuations and fundamentals matter in the long run. Yeah. If you look back to 2021, when the Fed started raising rates to combat inflation, the cost of capital went up and liquidity wasn't quite as plentiful. And in 2022, the Magnificent Seven stocks went down 45%. Then they went up 100% the next year. Right. This year, some of them are all up. The big guys are up the most again. Yeah. Yep. And I believe a lot of that's driven by passive investors. And there's also a lot of people on social media, like you said, that will gravitate into different things, whether it be Bitcoin or certain stocks that become popular, like Tesla. And when things get really popular and a lot more popular than they probably deserve to be relative to their underlying earning power, you get a dislocation versus the intrinsic value of the company. And what that means is that it's like a rubber band. The further you stretch it, the harder it's going to whip you once it goes the opposite way. Mm-hmm. So I think that's the danger now. If you're investing in index funds or just high flyer stocks that you hear your friends are in, you have to remember that they don't just always go up. They do go down too. And if you've had an exaggerated price movement, there's a point at which the risk probably outweighs the upside. And that's the hardest choice to make in today's environment, is when to take profits and on things like that. You can't ignore it. You want to be in things that are generally in favor, but you also have to keep a little bit of a valuation compass if you care about risk management.
So that brings up, kind of another follow-up question to that is when do you, well, really, I think I have two questions with this. So I'm going to back up here. First one is you're saying, we've gone from 30+% to 60+% passive investors. Do you, is it your suggestion that as an investor, you should be not investing in like mutual fund, that you should actually be looking at company fundamentals and picking your own stocks? Or is that sort of what I think that's probably what you do, but I would guess as a retail investor, do you think that that's something that people should be doing on, like, kind of, I guess, on their own?
Yeah, good question. I think it's good to have some diversification. That's like the only free lunch in investing is diversification. So, I have no problem if somebody wants to have some passive investments in their portfolio, because the fact is passive investments have beaten most active managers over the last 10 years and even the 10 years before that. So it's a low cost way to gain broad market exposure. It's just as it becomes ever more popular, the biggest stocks that benefit the most from all those flows are getting more and more overpriced. In 2013, Apple was not as big as the Russell 2000 index, the small cap index. There's 2,000 companies in that index, was about 1.4 trillion. Apple was around 400 billion, I believe. Today, Apple alone is bigger than the entire Russell 2000 index, and it's also bigger than the stock market of major European countries. And the biggest reason for that is not just because they're selling a lot more iPhones, it's because the valuation's gone up quite a lot. In 2013, the Russell 2000 traded a little over 1 time sales. Apple traded about 2.5 times sales. Today, Apple trades over 8 times sales. The Russell 2000 index still trades around 1.5 times sales. So that's a valuation premium that's inflated, I believe, largely due to the passive money that's flowing into the biggest companies. Microsoft also traded around a 2 times price to sales multiple in 2013. Today, it's, I believe, 13 times. So if you buy an S&P index fund, you got to remember that someday there's going to be a mean reversion when enough people realize that not everybody can invest passively. If John Bogle is the godfather of passive investing, he founded Vanguard and really inspired the whole movement in the 70s. And even he said months before his passing in 2018, he wrote an article in the Wall Street Journal where he warned people that not everybody can be a passive investor. The markets will break. And the big problem I see today is nobody knows where the line in the sand is. We're at 60% of US stocks are passive. We know it can't go to 100%. Even Bogle himself said that would be terrible for society and the markets would break. But nobody knows between 60 and 100% where we're supposed to worry. And I already see a lot of signs that the biggest companies are getting quite extended on valuations. But at the same time, that's something that I can't forecast when that ends. The passive share may go to 65, 70, 75%. And if it does, these big companies are going to keep outperforming everything else like you can't even believe, because it's an exponentially designed machine. And so I would want to, if I'm going to own anything that's mega cap, which I do own some, I trade them. I would not invest in the long term in Microsoft, Nvidia, Apple, or any of them, because they're all very, very expensive. And when this trend ends someday, they're the ones that are going to be left holding the bag more than any other stocks in the market. So I trade them because I have to participate where the money is going to go. That's my job as a professional investor for my clients. But I also have to risk manage that. So I don't just buy and hold the big caps. And if you're a passive investor with part of your portfolio, I would recommend being active in some way, shape, or form with another side of your portfolio, just so that you are counterbalancing for whenever that trend shift happens. And I think that'll be a major moment in markets. It's just nobody can predict when it'll happen.
Yeah, and I guess that inability to predict is tough, because I mean, so we've talked about NVIDIA, so I'll tell you and listeners a funny story about NVIDIA. My it's a sort of a sad start to the story. My father passed away over 10 years ago. He did not have a lot, but one thing he had, for I don't know what reason, he had invested in 100 shares of NVIDIA. And so those got passed on to me and my brother. And he bought 100 shares at $15 a piece. And so that was before, like, I think the stock has split twice since because it split recently. And I think there was another time in between there. And so, I mean, NVIDIA is like up I don't know, thousands of percent since what we got from our dad. My dad got NVIDIA because he liked video games. That's the only reason. He's not, there's no at the time none of us knew anything that they were going to lead the AI sort of landscape. So my question behind that is always like, when do you, I mean, how are people supposed to decide when to kind of harvest the gains? Because as you said, you can't predict when that train is going to stop going up the hill. But it was like that stock had gone from $15 when he bought it to I think like $250 a share, and it was like, well, we should sell this now. And but since then has gone far higher than that. And so it's kind of like, what do you say, or how do you manage things like that? And like, obviously, once you've sold it. There's not this like, you can't sit there and think, oh, I wish I kept on to this forever. But like, how do you suggest people manage things like that? It's a bit emotional, I think, when it comes, if you're doing it yourself too.
Right. Yeah, no, I sympathize. It's harder to know when to sell than when to buy, generally speaking. I think professionals, retail investors alike, that's a bigger challenge. And so I look at valuations, I look at technical indicators, and I look at where I think the overall market cycle is. I think in terms of where the market cycle is there's a lot of ways you can look at that, but I think the biggest companies that are the most owned by the passive machine, like NVIDIA and Apple and Microsoft, it's interesting how they went down a lot more than the market in 2022.
Right.
And now they've been rallying a lot more than the market last year and this year.
Yeah.
I think that makes a lot of sense, because if the most money, with money is going net inflows into the equity market, and more than half of the equity market is passive, it's preordained where that money is going to go. It's going to go to the biggest companies. It's been happening for 10 years. And it's very evident across a whole lot of different things you could look at. However, there are times when money comes out of the equity market. We haven't seen many of those. We saw it in 2022, and I think it was a glimpse of what you have to be weary of if you're in bigger companies that proliferate the indexes. So I would try to use my assessment of where the market is likely to go overall as my main lever for whether I want to be in a name like that or not. And one of the things I point to in the book that is it's not a super simple way of looking at where the market's going to go, but I think it's one of the simplest things I can show people. If you look at the last few decades, going back to 1980, about half the time GDP in America has been accelerating on a rate of change basis, meaning we're going up, we're growing more than we were before. And about half the time growth has been decelerating. All of the equity returns in the US stock market have accrued to environments when when GDP is accelerating. The net return is slightly negative when GDP growth is decelerating. So what happened in 2021 is we had huge GDP growth because the Fed overstimulated the market by printing way too much money. 26% year over year, they drove up the M2. That caused the biggest GDP growth in decades. And the thing that's problematic about that is it's a really high hurdle to jump over the next year because everything's rate of change based. So it was very, very obvious that we're going to have a growth slowdown in 2022. And if there's any point in the future where you feel like you have a reason to believe growth is decelerating in the economy, I would use that as maybe a clue to start paring back your big cap exposure. Because what happened in 2022 is some of the value smaller stocks didn't get hit as bad. And I think that's what the next bear market looks like as well. These big caps are going to lose the most because they have the most airs in those balloons, right? So when it pops, it's the loudest. And that's where you want to be careful, is when the economy starts to decelerate into a recession. If you can't predict that, then I would just recommend diversifying. Own some of the big caps, own some things that aren't just market cap weighted, whether it's equal weight index, value fund that you think is good, whatever you want to do. Just don't buy based on market cap, because when the market's going up, those stocks are going to go up more than the market. When the market's going down, they're going to go down more than the market in all likelihood.
That makes sense. What would you say to a question, or I guess relating it to, the Magnificent Seven are basically all tech stocks, right? Like Amazon started as a book selling company, but it's a tech stock now, right? It's a tech company. What do you what do you think about the fact that our future very likely is very tech driven? Obviously, there's a lot of talk about AI, things like that, and that's probably contributing to some degree as to why NVIDIA, Microsoft, some of these are going up so much. Do you think, and I actually, in answer to this question, I would like you to maybe contrast it to the tech bubble of 2000, because do you feel like this is kind of a tech bubble in the sense that these seven stocks are basically all tech stocks? Like, do you think that we're in a place where that could happen again, or do you think that tech is going to be so important for our foreseeable future that those stocks might just continue the ride? And I don't, or maybe you have some other answer to that. It doesn't necessarily have to be a two, either or. I just want to know kind of your take on that.
Sure. I think it's a different environment than the 2000 tech bubble. Fundamentals are much stronger for the biggest tech stocks today. I think one of the subtle things about that that's hard to see is that these companies have a cost of capital advantage. They have, such an advantage that if they can start new businesses like Amazon you bring up, they've recreated UPS in a few years, basically, because they have enough capital to do it. And you see, sorry about that. You see companies like the big tech companies are getting into the streaming battles, right? Like Amazon's in streaming, that Apple's got its own channel. They can compete with any business in the world because they have this massive scale. And part of it's from the passive machine. A good example of how this works is Google was fined, I think, about $800 million due to antitrust violations a few months back. And people wrote about it in the news. It was like a front page Bloomberg story. But what people didn't see that day, I wrote about it in a Forbes article, is that in that single day, the S&P 500 ETF happened to take in a lot of inflows. And based on Google's weight in the S&P, they took in more than the $800 million fine in that one day from passive inflows. So it's just like, these things are monopolies, and America's funding them willingly. We give, if 85 cents of every dollar that goes into a retirement fund goes into target date funds that are mostly in passive vehicles, the country is basically supporting these monopolies with their paychecks. But then they also complain about wealth inequality all the time. That's a big controversial issue. Well, we're promoting wealth inequality based on how we invest. And so by doing that, we give these monopolies a huge edge. They do have strong earning power. At least most of them are growing. Apple's not really growing. That's it. The only thing growing at Apple is its valuation. I mean, their sales are down over the last 2 years, but it trades at the highest PE or near the highest PE it's ever traded at. Has nothing to do with fundamentals. It's just this passive machine. And so I don't think it's easy to see anything other than maybe the Nifty 50 environment, which is way back in the late 60s, early 70s. There was this thing called the Nifty 50 bubble, where there's the 50 biggest stocks in the US that dominated the mutual funds. There was a story that went around Wall Street and America that, just invest in these top 50 companies and call it a day. You don't need to do anything else. They always outperform because they're the best growth companies. And they really were growing at the time. So it was kind of like a self-fulfilling prophecy to a certain extent. But, some of those Nifty 50 stocks aren't doing too well today. Polaroid was one of them, Kodak. Disney and Coca-Cola were in that group too, and they're still around. But it's really hard to know which technology companies are going to dominate the next 10 or 20 years. Of all the sectors, historically, that's one of the most cyclical and prone to disruption. The only thing that's prohibiting that from taking place as much today is this passive bid that keeps supporting these big tech companies. And the antitrust regulation isn't enough to override their advantages, at least not yet. So I don't think it's the same as in 2000 because of that variable. In 2000, you had a lot of companies that were trading on how many website visitors they had, and everything but earnings. And today you look at like Microsoft, for instance, they have tons of free cash flow. Apple is going to buy back $180 billion worth of its own stock because of how much cash it has on its balance sheet. So with the passive machine buying Apple and Apple buying that much of its own stock, it's hard for it to go down a lot, even if they don't do very well in earnings.
Yeah.
So I don't know if you call that a bubble or what, but it's just something to be aware of, I think.
Yeah. Yeah. No, I mean, it's a, again, I don't understand this nearly as well as you do, but it's something that's sort of been fascinating to me because those specific stocks are such a big part of our lives, basically. Like, I mean, I know not everybody uses an iPhone, but like the majority of people use an iPhone for their everyday, and now it's like it's a computer in your hand. It's like you can literally conduct business from that. And you mentioned the streaming services. They all have a streaming service. Like, it's interesting to see that most of the companies that produce cable are like failing because now everybody just wants to use the streaming services and stuff. And so your point about we don't know what's going to be big in the future, I think is a really important thing to remember. I think more there will be other sort of unicorn type companies that come along and dominate some sector or something like that. It's and I guess it's possible that it's hard to imagine Apple or Amazon or something like that just going away at some point, but who knows what's going to happen down the road. I guess I feel like
Just
everything
remember,
you're
no
saying.
company that's become the biggest in the world ever stayed there, which you could
Yeah.
argue makes NVIDIA automatic sell today.
Yeah.
You may regret selling NVIDIA tomorrow, next week, next month. Maybe it keeps going up, but there's never been a company that got to the biggest in the world and stayed there forever. Never happened. And if you actually go long term in history, buying the biggest companies every decade actually is a very bad strategy. Small caps have outperformed large caps over the very long term. An equal weighted index has outperformed a market cap weighted index over the very long term. It's just extremely skewed the other direction the last 15 years or so. So I totally hear your point. And maybe these companies will stay dominant monopolies. If nobody does anything to change this paradigm, they will get more and more powerful. I just don't think that that's something that continues in perpetuity without a lot of backlash. I think there's not enough people that are awake at the switch right now and realize what's happening in the capital markets and the stock market and how skewed it is by size and these passive investors. But it is what it is. They're quite powerful. Their earnings are real. Their products are real. But there's situations like Tesla, which ran up in a manic fashion in 2020, if you recall, and that stock hasn't done very well the last 4 years. I believe it's down quite a bit. And GameStop, it's not ever reclaimed the highs from 2021. And AMC was really fun while it lasted, and Vanguard bought the snot out of that after all the retail investors piled in, because that's what it does. It chases momentum. But guess what? AMC is down about 99% from its high. So I don't think 99% drawdowns in NVIDIA's future, but I do think that a big correction in those names will happen at some point. And so that's why you want to be diversified in real estate or cash or gold or Bitcoin. There's all kinds of things you can own. You just don't want to own only large cap US stocks.
Yeah. Yeah. And you took the words right out of my mouth. And that I think that the take home message here really is diversification, whether that's within stocks or with across asset classes. Like, you just don't want to be, and I would also argue, sort of the follow up to that take home is you need to try and understand a little bit. You need to try and understand a little bit about where your money is and what it's doing, and sort of get connected with someone who like yourself, like knows why you wouldn't necessarily want to put all your money in NVIDIA. Here are the reasons why. Here are the for the long term there are better strategies. So I think that's the very smart and kind of valuable feedback. Michael, I'm going to switch gears here. This is fascinating, but rather than keep you all night long, I want to touch on a few or ask you the questions that I ask every guest. And the first one is based on the name of the show being Know Your Why. And so I always ask every guest, what is your why? What's the motivation behind what you do and your success and all of that, and kind of keeps you moving forward?
What's my why? I should have thought about that before giving the name of the podcast, and I kind of did. But I think my answer to that question, Jason, would be one of the themes in my book is that investment management, wealth management, whatever you want to call it, it's not just about numbers, but it's also about getting the narrative right. What I mean by that is everyone has a story about money that's best told in their own words, and they're all different. We're all different. One of the things I think the financial industry does is it's really great at churning out cookie cutter products, but as I like to say, people are not cookies, they're complicated.
Mm-hmm.
And I've known that through my career because I've not only been a portfolio manager, but I've worked one-on-one with clients, whether it was at seminars or right now I work directly with private clients. And I know their life stories are all different. Their core values are all different. And so one of the things that I think is really important is for the industry to help people customize better. And that's one of the goals for my firm is to have a story behind every financial plan that we create for someone that's their story based on their core values and history, and using those as breadcrumbs to find our way to a compelling future that we can envision for them. A financial plan, I think, should be not just numbers, but an emotional magnet towards a compelling future. And we're not moved emotionally by numbers as much as we are stories. A study I point to in the book from the London School of Business shows that if people are given just statistics alone, they retain 5 to 10% of the information. If you add a picture to the statistics, the retention goes up to 25%. But if you frame it along with a story, retention surges all the way to 65%. That's because that's how people think. They think in narrative. They think about their life almost like a movie. I know that's how I think of my life. And I stumbled upon this realization actually in a roundabout way. I made my wife anniversary present. I documented the first 10 years of our relationship together. It's like a 6-month project using iMovie to basically find all of our original emails, photos, videos, when our kids came into our lives. And as I was editing the reel, and it took 6 months, it was a big effort on my part, but I kind of fell in love with the project because it helped me fall back in love with my life. And I noticed as I was doing it that our life together has been a series of bull markets, bear markets, different chapters, if you will, big victories, crushing defeats, wonderful moments, sorrowful moments. And that's how stories work. And what I realized by the end of making the film was that I'm not just motivated by money. I'm a money manager because I like managing money. I like the game. I love the game. I'm passionate about it. I take it quite seriously. But at the end of the day, I view money more as a vehicle than a destination. And I think that's how my clients think about it. So I recently brought on a chief storytelling director to join me at the firm. It's kind of an untraditional role for an investment management firm to have, but this gentleman's got a great background in storytelling, and we're going to work together to help clients create a story behind their financial plans that are based on their goals, core values, their why, essentially. And I think a great way to express your why is through your own story. Yeah. And so that's something I'm very excited to work on for the next part of my career.
That's super cool. I think we've had business coaches, life coaches sometimes on the show, and I know story work is a big part of what goes into a lot of sort of that coaching side of the equation, and I think that's fantastic that you're applying that directly to people's kind of money management, financial plan, all of that, because I never really thought about it that way, but it really does come down to kind of what's your story, because you have your story, that's the part that's already written, but also you're trying to construct what your story looks like from here on out. Like, what do you want your happily ever after to look like? And that's a lot of what when we talk about investing, that's really what we're trying to build for, right? It's not for today. It really isn't for today. It's for what do things look like 5, 10, 25 years down the road, or for our children's lives and all of that. So I think that's amazing to bring on a chief storytelling officer. Am I kidding?
We decided on director instead of officer. Okay. Yeah. Officer sounds a little stuffy. But we're going to make documentary films for our clients about their lives to help them reconnect with their past, the parts they're most proud of, the core values that are inspired by the people that were most influential when they're growing up, and help them connect those breadcrumbs to their future that they are excited about. It's one thing to say, I want to retire when I'm 65, or I want to create an emergency savings fund, or, any of these esoteric, bland goals that we have in the financial industry. But it's way more meaningful if you could see your life as a story. You're the main character, and you're taking the lessons you've learned up till now, you're applying them to a future you're inspired by. And these are goals that are more rich in flavor because they're something you can imagine, you can feel, you can almost taste. If you want to retire at 65, that's fine, but I don't find that very motivational personally. I find the idea of financial freedom motivational if that means I own my time and I can spend more time with my family, and I don't have to be away from my kids as much, and I can take trips around the world and show them everything this beautiful earth has to offer. I mean, that's what gets me excited personally. And I think most people are similar, but I think it's really helpful to have a coach that can help you look at your story in an objective way, find the positives, and extract from that like compelling vision for the future. And that's the goal.
Yeah, that's fantastic. I love it. So when people hear this, I'm sure they're going to find that super interesting. How should they reach out to you? What's the best way to connect?
You can go to our website, www.silverlight.us. You can also follow me. I write for Forbes. Haven't done an article in a little while because my book just came out, but I write regularly from there. So if you want to subscribe, you can subscribe there. Yeah.
Okay. And we'll put those things in the show notes too, so people can connect directly with you. Michael, this is great. I really enjoyed this conversation. I think there's a lot of value that people get out of this, and folks listening definitely connect with Michael, and the idea of having a kind of your financial plan as a story. It's just, I love it. I think it's a very good way to I guess create interest in something that I think a lot of times people shy away from. They don't want something they don't want to talk about, that kind of thing. So thank you so much for coming on the show, and taking the time out and sharing this with us. I really do appreciate it.
Thank you, Jason.
Yeah. And folks listening, make sure you connect with Michael, and please like, rate, and review the show so that we can get more great guests. And thank you all for listening.
Hey there, I am Dr. Jason Balara, and this is the Know Your Why podcast, where we explore the why behind success. Every week, I meet with real estate investors, veterinary entrepreneurs, mindset coaches, authors, and fitness professionals to uncover their why and how it drives them on the winding road to success. What is your why?